Anyway, I am back in my office. I have installed a pair of Netgear Orbi meshes, and I now have awesome internet. My internet speed went from 90 megabytes per second download to 230. Yeah, I don't care. As long as it's stable, I don't care. I mean, this was beyond my technical capability. There's one downstairs Ethernet connected to the router, and there's one right over here on a file cabinet. It works great. That's all I have to say. Okay, let me tell you what we're going to do tonight. If you haven't sent me what you want to do for your project, get it to me, because you need to start, getting all your data together. In our chapters tonight, we're going to look at some of the different sources for information that you might want to use. So it'll kind of help you do that. Okay. I want to share something different. I want to share. Yeah, show me everything. Chapter 2. That's what I want right there. Well, let's put that down and move it somewhere out of the way. Okay, we're going to look at chapter 2 and 3. And I will then tell you about the test. Okay, chapter 2, security markets and transactions. Like every chapter, it's got learning objectives at the beginning. We're going to look at the basic types of security markets, IPO process, how transactions take place, something about globalization, just kind of in general trading. Now, the basic goal of a security market is so that you can transact financial transactions quickly and at a fair price. We're going to look at different types, broker and dealer, electronic and high frequency HFTs, and general market conditions. Now, types of markets. Money market. When you talk about the money market, that's the market where short-term debt securities trade. They're debt. Capital markets is long-term. That's stocks and bonds. The SEC oversees all of that. Now, primary market, this is where new issues of securities are sold. That's where IPOs take place. That's where seasoned equity offerings take place. This is when the firm, for the first time, or the firm issues securities to the public. This is annual IPO data, and it's kind of interesting. Look back here, 99 and 2000, huge first day return, which means they underpriced and they left a lot of money on the table. That's what that means. That's gone down quite a bit. Now, looking at the primary market, you've got three choices here. Public offering. That's when obviously securities are offered for sale to the public. A rights offering is when shares are offered to existing shareholders on a pro rata basis. So if you own, say a company wants to raise funds, but they don't want to do a public offering, they can offer shares to shareholders. And if you own 1% of the shares of the company, you can buy 1% of the rights offering. In other words, you can maintain your percentage of ownership. Private placement, you see this a lot more with bonds than with stock. The whole offering of securities is sold directly to a group of private investors. It avoids a lot of SEC registration fees. It avoids a lot of fees in particular. It's more bond than stock. Okay. Going public, the IPO process. A firm wishing to issue securities for the first time, they're going to need an underwriter. The underwriter helps them design the offering, write up all the documentation, everything that has to go to the SEC. They promote it and they facilitate the sale. They put together a prospectus. We'll see one on a coming slide. It's the whole statement that describes both the company and what they're issuing. There's a quiet period between the time the prospectus is filed with the SEC and the company actually starts offering shares. they're restricted in what they can say. The first prospectus is called a red herring. You'll see it on the coming slide. It's available during that waiting period. It doesn't have any prices on it. One job of the underwriter is to do what's called a roadshow. What they do is they go out and make presentations to financial advisors around the country. They're drumming up interest in the offering. And what they're doing is called book building. They want to find out, say from an analyst says, well, if this stock comes out at $20 a share, I'll take 1,000 shares. But if it comes out at 25, I only want 500. They're finding the level where the price should be for them to bring this out. There we go. This is a prospectus. Note right there, note the red up at the top. Note that there's no prices on it. This is before the offering. There's no prices. The other thing is, note down at the bottom, those are the underwriters involved in this: Goldman Sachs, JP Morgan, Deutsche Bank, Allen and Company, Bank of America, Merrill Lynch, etc. The order down there is very important. Underwriting is very much a reputation business. So this was Dropbox. A company similar to Dropbox wanting to go public, they're going to search for an underwriter who's had experience successfully bringing a similar company to market. So the names down here, you'll note, are not in alphabetical order. They're in the order of importance. That is important. That's part of the reputation. Now, I said they were underpriced. The market price minus the offer price divided by the offer price. IPOs are typically slightly at least underpriced because you want them to come out and the price to go up on the first day. That's how you kind of want it to go. That's what the book building is about. They're looking at that and going, okay, at $20, we could probably sell a lot of these. Maybe if we come out at 22, it'll bump to 25 the first day. Everything will look good. The gross proceeds, the offer price times the number of shares sold. Now, primary market, the investment banker. That's the intermediary that specializes in assisting companies in issuing new securities. They also advise them on mergers and acquisitions. For IPOs, they're the underwriter. Now, they can do it on two ways, and I think we probably talked about this probably in 331. They can do it on a best efforts, or they can do it on a guaranteed basis. Guaranteed, they buy all the shares from the company, issuing them at a discount, and it's firm commitment. They're going to sell them. The flotation cost is higher for that. Best efforts, they're going to make their best effort to sell them. So the flotation cost is lower. For large security issues, they're going to form an underwriting syndicate. In other words, one investment banker is not going to take on the whole risk of this whole thing. They're going to form a syndicate of other underwriters. And that's what we saw down there at the bottom. All those other names, that was the syndicate. Then below that, there's a selling group. And we're going to see a little chart coming up. Here it is. There's the issuing firm. There's your lead banker. Here's the syndicate across here. And here's the selling group. And here we are down here buying it. So they're spreading their risk around is what's happening. Now, there's a kind of a new different thing here called a direct listing process. I haven't seen a lot of this. The company doesn't really issue any new shares, so they don't raise any money. They transfer some existing shares to a stock exchange who sets the initial price and opens trading. So what it does, it saves the issuer a lot of money in investment banking fees. It allows people who got shares in this company before IPO to cash out. So it's got some pluses to it, but on the downside, there's no roadshow. There's no underwriter. So nobody's explaining who this company is, what they do, what the future looks like. No telling where the initial price is going to be set. The company doesn't raise any money. There have been some that have taken place. Okay, secondary market. After the shares are issued and they're trading, they trade in the secondary market. New York Stock Exchange, NASDAQ, those are secondary markets. And that's important right there. It provides continuous pricing mechanism. If you want to know what a share of Apple is worth right this minute, every one of you can pull it up on your computer or on your phone. It provides liquidity. In the United States, our markets are incredibly liquid. You can buy and sell securities in a heartbeat without significant loss of value. That's the second dimension of liquidity. Yeah. Major segments are national securities exchanges, and there is an over-the-counter market. Smaller, unlisted securities, much riskier. Here's our national security exchanges. Probably a lot of those you never heard of. Here's the big ones down here. NASDAQ, NYSE, Archipelago, Chicago is part of that. Philadelphia Stock Exchange. Now, different types of markets. There's broker markets and dealer markets. The national and regional securities exchanges are broker markets. Trades are executed by a buyer and seller who are brought together by a broker. Think real estate broker. A real estate broker doesn't own the house. They bring a buyer and seller together. There. A dealer market. Now, New York Stock Exchange is a broker market. NASDAQ is a dealer market. The market maker is an intermediary. He buys from me and sells to you. And he makes his money on the difference. It's called the bid-ask spread. So in this case, think used car dealer. The used car dealer takes possession, takes ownership of the car and resells it. There. Now it's kind of stuck down at the bottom, but the bid-ask spread is the difference between the ask price and the bid price. The bid price is the highest price I will buy it from you. The ask price is the lowest price I will sell it to you. And there is an entire, good Lord, I can't tell you how much research on the bid-ask spread, some of which I've done myself. Okay. Broker markets. New York Stock Exchange is the largest stock exchange in the world. Designated market maker. They used to be called specialist, but they're now called designated market makers. If you see pictures of the floor of the New York Stock Exchange, the DMM is the guy in the suit or the lady in the suit. The other people around there that aren't as formally dressed, they're all their little staff people. Designated market maker is formally dressed. He's standing there to bring together buyers and sellers. He manages the auction process. That's his job. Most of the regional stock exchanges are modeled after New York. Their listing requirements can be more lenient, but most of the securities are also listed on New York. For example, Chicago, the Chicago Stock Exchange, one year at a conference, we toured the floor. We were there on the floor when the trading opened. They open when New York opens, exactly. A local company might list on the Chicago Stock Exchange just to be local, but they are listed on New York as well. Okay. Broker markets. The options exchanges are broker markets. Dominant one is the CBOE, Chicago Board Options Exchange. Futures exchanges, they are broker markets. And the dominant one there is the CME Group, which takes into account Chicago Mercantile, CME, Chicago Board of Trade, New York Board of Trade, several others. Commodity Exchange, New York Mercantile. Now, dealer markets. New York broker market, you can see the trading floor. I mean, they've become more and more electronic, but you can see it. There's pictures of it. And there's people down there, trading. Dealer markets, there's no centralized trading floor. They're all linked electronically. If you saw a picture of the trading floor at Salomon Smith Barney, it is a gigantic room with like 2 or 3 people together, a trader and his assistants, with multiple computer screens. all over the room. That's all it is. Now, with a dealer market, there are multiple market makers making a market. In other words, standing ready to buy and sell a stock at any time. Depending on their own inventory situation, they can adjust their bid and ask price. If they want to buy more, they'll adjust one. If they want to sell more, they'll adjust the other. The bid is the highest price offered to purchase. In other words, the bid is the lower. Its ask is higher, bid is lower. The bid is what I'll buy. I'll buy it from you for $20. I'll sell it to you for $22. The ask is the other half of that. Now, let's say somebody wants to be aggressive on one side. They could say, my bid is 20, but my ask is 25. I'm really not interested in selling. I'm interested yeah. NASDAQ, largest dealer market. Amazon, Microsoft, Intel, all of those are listed. A lot of them listed there to begin with because they couldn't meet the listing requirements on the New York Stock Exchange. They're very happy there, so they don't move. There are over-the-counter markets. Some of these either cannot or will not meet the requirements to list on NASDAQ. There's an over-the-counter bulletin board. And there you can see there's over-the-counter pink. They are completely unregulated, very risky. There's the QB and there's the QX. And they get they're a little bit better in terms of disclosures as you go up. But you're talking about risky. Whoa, ECNs. Electronic Communications Networks really came into prominence in 1997. They are automated computer-based trading systems. They electronically match orders and execute them. Obviously, they work the best for high-volume, actively traded securities. And some of that list that we looked at back there, some of those Box and Edge and some of those are ECNs. They're very active in after-hours trading. They only charge a transaction fee, and it can be very economical. Another thing that's gotten a lot of attention is HFT, high-frequency trading. This is algorithmic trading. It's computer-based. Firms literally are concerned with, like I'm concerned with my speed here. They are concerned with being physically located as close to the exchange as they can so they can get the information as fast as possible. It's amazing. They are using computer-based strategies and moving in and out. And by now, they're saying at least 50% of equity trading is high frequency. And you all may not remember, stock prices used to be quoted in eighths, 1/8. We've gone to decimal trading now, which obviously makes a lot better sense. General market conditions, I suppose a bull market, rising prices, we're optimistic. Bear market, pessimistic, prices are falling. We're not very optimistic about how things are going to happen. Now, diversification, including a whole bunch of different securities in your portfolio. In other words, this is the opposite of don't put all your eggs in one basket. Include a wider range of industries and securities traded in different markets, even denominated in different currencies. All of that's important, and we're going to look at some of that. International markets have gotten a lot more important. Securities exchanges operate in more than 100 countries. It tells you right there. The top 4, you can see them: New York, NASDAQ, London, and Tokyo. If you would have missed this as well. Back when those countries were coming out, Azerbaijan, some of those coming out from under the Soviet Union, a lot of times one of the first things they wanted to do was create a market, a stock market. You can do it with a computer, a small computer, because it brings in capital to the country. That's what they're trying to do. A lot of mergers and cooperative arrangements between exchanges. NYSE is actually part of Euronext, or it is Euronext. Even the bond markets have become more global. And bond markets are not extremely liquid and not very exciting. Paris, Amsterdam, Brussels, and London exchanges and a London-based derivatives exchange combined to form Euronext, which in 2006 merged with NYSE. So, I mean, we're becoming a lot more international. Why would you do it? Well, you got an opportunity for high returns. Foreign markets don't necessarily move with us, with the U.S. markets. They move, nowadays they move a lot more than they used to, probably because of technology and how easy it is for information to spread all over the world in a heartbeat. They do tend to be riskier. Well, there you go. Couple of ways, few ways to do it. To invest foreign. You could purchase shares of a US-based company with a lot of foreign operations. Or you can do it directly. You can purchase securities on foreign stock exchanges. Risky, but you can do it. You can buy the securities of foreign companies that trade here. And there's two options on that. ADSs and ADRs. American depository shares are foreign stocks that trade on our exchanges. So they meet the registration criteria. Those are direct shares. ADRs, American Depository Receipts, they're more like a mutual fund that only holds stock in one foreign company. You buy shares in the ADR. So you're not exactly holding a share of the company, you're holding a share of the pool. Now, the advantage to that is they handle, everything's dollar denominated. They handle all of the currency conversion for dividends, anything like that. They do have to meet, there's 3 different levels of them. They have to meet different registration criteria. Well, investing internationally can be risky. All the normal investment risks apply. Government policies. You've got the possibility for unstable foreign governments. They have different laws. They have different taxation. They have different political conditions. Very important. Their regulation of their markets, I can already tell you, is not as stringent as ours. The SEC is the gold standard. For whatever we think about how well they do it, they are the gold standard internationally for regulation of security markets. Nobody else comes close. And you've got currency exchange risk. This is the risk that you're investing in a foreign currency. And while the price may go, the price of what you own may go up, the exchange rate may change the other way that wipes out your gains. Okay, trading hours and the regulation. Our markets trade from 9:30 in the morning until 4 o'clock Eastern time, period. After hours trading, ECNs trade, you know, they offer after hours trading. But most of those are what they call crossing markets. It means if you offer to sell 300 shares at $20 and I want to buy 200 shares at $20, that's not a cross. It's got to be an exact match. Identical opposing orders. Regulation. Well, we got a lot of it. And I do not anticipate you remembering all of these. All the security laws are meant to protect investors and the participants. 2 of the newer ones, Sarbanes-Oxley 202, that was aimed at eliminating corporate fraud that had to do with accounting and information release. Think Enron, Tyco, WorldCom. Dodd-Frank was more consumer protection. Now, both of those had to do with ethics. States have what are called blue sky laws, and this is to prevent investors from being sold nothing but blue sky. That's why it's called that. Okay, going back, here's some of our basics. Securities Act of 1933 and Securities Exchange Act of 1934. You can tell by the year. Securities Act 1933, that was in reaction to the Depression and the market crash. Required full disclosure. The Securities Exchange Act established the SEC. The Maloney Act, this allowed self-regulation of the securities industry. Think about that. They regulate themselves. These last 2, the Investment Company Act of 1940 and the Advisors Act, these were more aimed at investment advisors and mutual funds. having to disclose their background, any conflicts, that type of thing. They have to register with the SEC. Securities Act Amendment, this abolished fixed commissions and established ECNs. Try that one. Insider trading was prohibited in 1988. So before that, it was okay. Reg FD. A lot of people think of that as regulation full disclosure. It's not. It's reg fair disclosure. What this was aimed at was companies would have these analyst phone calls, and different analysts would be on the call with people from the company, and they would disclose things about the future for the company, the future for the stock. This requires them to make that available to the public. It's fair disclosure. They have to disclose it to everybody. And there's Sarbanes-Oxley and Dodd-Frank again. And here's kind of a recap of all of those. Okay. Let's look at purchasing things. Types of transactions. We're going to look at 3 basic types. There are hundreds of them. The 3 basics: long, margin trading, and short selling. A long purchase, that's the most common thing there is. You buy securities in the hope that the price is going to go up. Buy low, sell high. It is by far the most common. Your return comes in the only 2 ways it can: cash from any dividends or interest if it's a bond, capital gain, difference between the purchase and the selling prices. And of course, it's reduced by transaction cost. Margin trading. Margin trading is when an investor borrows funds from the brokerage to buy securities. There's a requirement. It's 50% right now for stock. It's set by the Fed. Back during World War II, it was up as high as 100%, meaning there was no margin. It's the minimum amount of equity that must be in the margin investor's own funds. Now, it's to employ leverage. You're using the debt financing to magnify your returns. You borrow money and use it to buy stock. And we're going to look at how it works. Okay, right up there. I'm buying 100 shares at $50 a share. Without any margin, right down here, it cost me $5,000. I didn't borrow anything. My equity is $5,000. With an 80% margin, I borrowed 20%. I had to put up $4,000. So my equity is $4,000. I borrowed $1,000. 65%, 50%, which is where we are right now. I borrowed $2,500. I put up $2,500. Okay, what if the price per share rises to $80? Well, with no margin, I have a capital gain of $3,000, 60%, 30 over 5,000. With 80% margin, it's 3,000 over 4,000, 75. At 50%, it's 3,000 over 2,500, 120%. So you're magnifying your gains. But if the stock price drops by $30, it magnifies your losses as well. Now, there it is. It magnifies your returns. It allows you to spread your limited capital over a larger number of investments. It magnifies your losses. And usually, I mean, you'll be charged interest rate on it. Usually, that'll be something above the prime rate. Okay, how do you do it? You have to set up a margin account with your broker. You've got to contribute at least $2,000 or 100% of the purchase price in cash or securities to get it started. The initial margin, is the minimum amount of equity that you have to provide. A restricted account is when that has gotten below that, when your account equity has gotten below that. Maintenance margin is the absolute minimum that you can have and maintain. If you drop below that, you're going to get a margin call. You're going to have to put money back in the account, or else your broker will sell the stock that you've got. Okay, here's your initial margin right now. As I said, it's 50% on stock, 30 on bonds, etc. Now, basic margin formula. Here's our example. You're going to purchase 100 shares at $40 a share. Margin requirement is 70%. So you borrow 30%. 30 times $40 times 100, $1,200. That's your debit balance right there. That's D. The price per share rises to $65. So your value is now $6,500. What's your margin position? Plug all those in. Margin requirement 70. You're at 81.5, so you're in good shape. Now this one, return on invested capital. Get to this. And we're going to see an example of this on the next slide because it total income received, total interest paid on the loan, market value at the sale, market value at the purchase, amount of equity. Okay, you want to buy 100 shares at $50 a share, $5,000. You think the price is going to rise to $75 within 6 months. So you think they're going to be worth $7,500. The stock pays $2 a year in dividends. So in 6 months, you're going to get $1 times your 100 shares, $100. Margin requirement is 50%. So you borrow $2,500, you have $2,500 in equity. The interest on the loan is 10%. So it's $250 times a half a year, $125. There's our formula, and there's plugging it in. Income received, your dividends. Interest paid, right there. Value at the market value at sale, $7,500. Market value at purchase, $5,000. Divided by equity, $2,500. Return on invested capital, 99%. Not too shabby, eh? Now, it magnifies returns, and you can pyramid. If you have excess margin in your account, you can withdraw it, or you can use it to buy more stuff. There's a lot of risk associated with it. If the price moves the wrong way, you're going to get a margin call, and you're going to have to put up money. Okay, let's look at short selling. Short selling is selling securities that you don't own. You borrow them. Your broker lends securities that are owned by other investors held in a street name. Now, your broker holds almost everything in street name, and that's a good thing. I think we look at that maybe in the next chapter. So they may loan securities that you own, and you're not going to know it, and it doesn't matter. Because if you called up and said, you know, those shares of ABC, I want to sell them, he's got to get them back and sell them for you. So you don't need to know. The investor's got to make a deposit equal to the initial margin requirement. This is the opposite of a long purchase. In this case, I'm thinking that the price is going to go down. I want to sell high now and buy it back low and cover my short. You make money when the price goes down. Here's an example. We're going to look at it. I sold 100. I have no idea what that was. I sold 100 shares at $50 a share. So I've got $5,000. Later, when the price dropped to $30 a share, I bought them back and covered my short position. I made $2,000. Here's an example. Margin positions. These are in your book too, by the way. Okay. Price per share is $50. Proceed from the sale, $5,000. Initial margin deposit, $2,500. Total deposit with the broker. He's got the $5,000 that's selling the shares plus my $2,500. So I've got $7,500 in there. The cost to buy back, nothing's changed. So the cost to cover right now would be the same as buying them, $5,000. Margin, 50%. I'm okay. Okay, what if the price drops to 30? Whoa, I'm in good shape because I've still got that, but now look, the cost to cover is only $3,000, $150. If the price goes up to 70, now the cost to cover is $7,000. I'm going to lose money. I'm going to get a margin call right there. That's what changed. The current cost of buying the stock back to cover. He's going to have to either deposit an additional to bring it back up to the initial deposit, or he's going to have to buy back the 100 shares and return them to the broker. It's dangerous. The advantages, if you think a stock's going to go down, you can short it. Whoop. The disadvantages, limited return because the stock price can't go below zero, unlimited risk because the stock price can go through the roof. if the stock price goes up, the short seller may have to buy them back. The price goes up enough. If you loaned out my shares of ABC at $20 a share and somebody sold them, and wow, all of a sudden it became the next GameStop. Wow, it's at $200 a share. I want them back. I want to sell them. The broker has got to get them back. Whoever shorted them is going to have to cover. Mm-hmm. And also, you can't have two people owning the shares at the same time. They don't own the dividend. They have to pay it to whoever they borrowed them from. It is risky. That was chapter 2. Questions about it? Did we like that? A lot of terminology. Okay, let's look at the problems that go with chapter 2. And find the thing I want. Chapter 2. Okay, share my screen. Get back to this. Share my screen. Chapter 2 problems. Okay. Oh, by the way, before we start on these problems, let me tell you about the test. Let me tell you something about the test. Let me move this little thing somewhere else, like over here. Okay. Interestingly enough, the test has got 25 conceptual questions at 3 points each, only 5 problems at 5 points each, because there just weren't that many. They weren't there. Some of these are so involved, they were not suitable. So when you're seeing all of this happen, don't get too panicked. Okay, number 7. Current exchange rate between the US dollar and the Japanese yen is 109 yen to the dollar. That is.
Hey, Miss Cool.
Yes.
Hey, I was trying to. It was asking me for a user ID or something like that for the finance lab. What?
Email me about that, because it should not.
Okay.
Email me. We've got somebody else that's having that problem, and our Pearson rep, Crystal Edwards, is trying to work and figure out what it is, because I know a lot of people have gotten on.
All right.
Okay. Email me.
Yeah.
Okay. Okay. How many dollars would you get for 1,000 Japanese yen? Well, that's an indirect quote. It's yen to the dollar. We need dollar to the yen. All you do is just flip it over. That's all. 1 divided by 109, and then multiply that times 1,000. Okay. Number 9 is, in each of the following cases, calculate the price of 1 share of the foreign stock measured in US dollars. Okay. There's the foreign currency, the share price in euros. There's the price, euros to the dollar, the share price in US dollars. And that's how I got it. 103 divided by 93. Right there. These are Swiss francs. These are all quoted just like we need them. Directly. Euro to the dollar, Swiss franc to the dollar, yen to the dollar. So we're okay. We just divide by it. Okay, let me get this, and I need to go away. I need to get to that right there so you can see the whole thing. Okay. Number 10. Aaron McQueen purchased 50 shares of BMW, a German stock traded on the Frankfurt Exchange, for 85.5 euros per share exactly 1 year ago, when the exchange rate was $1.10 USD to the euro. Today, the stock is trading at 87.10 euros per share, and the exchange rate is $1.16 to the euro. Did the euro depreciate or appreciate? The euro appreciated, because it takes $1.16 to buy a euro now, and it took $1.10 then. So the euro is now worth more. That's what it's saying. How much in US dollars did Erin pay for 50 shares of her BMW when she purchased them? A year ago, she bought 50 shares. That's in euros. The transaction value is that times, this is in euros, the exchange rate, and that's how she got it. And the next one is, for how much in US dollars can she sell her euros today? I'm doing the exact same thing. Today they're selling for 87.10, 43.55 euros, 43.55 times $1.16. So while they went up in euros, the euro appreciated. So she actually lost 3.49. I don't think that was a loss. Okay, this one I got to make it smaller again so you can see it. Hope you can see it okay. Number 14. I have no idea. I can hear the little guys downstairs barking. Assume that an investor buys 250 shares of stock at $37.50 a share, putting up a 45% margin. What's the value of the position? Okay, total purchase, $93.75. 250 times 3. How much equity capital must the investor provide to make this margin transaction? Cancel. I don't want to do anything. Okay. He's got to put up 45% margin requirement. So he puts up 42.1875. What's the debit balance in this transaction? The difference. The total is 93.75. He's putting up 42, so the debit balance is the difference, 51.56. If you put it in a balance sheet, look, let me go over here and look at it. Go over here. The stock is worth that. He deposited that. That's the amount of the loan. Now, what can change here? The loan doesn't change. The stock can change. So the margin value can change. The loan doesn't change. Make sense? This changes based on the current value of the stock. This changes based on the current value of the stock. This changes to make it balance. The loan doesn't change. You borrowed $5,000. Boy, they are having a fit down there, and I don't know why. Okay, number 16. Assume that an investor, and I'm going to have to make it small again. I don't know why I keep getting that. Because I want you to see the whole little thing on the screen. Number 16. Assume that an investor buys 100 shares of stock at $35 a share, putting up 75% margin. What's the debit balance? How much in equity funds must they provide? If the stock rises to 55 a share, what's the investor's new margin position? Okay, here you can see it. 100 shares at $35, $3,500. He put up $26.25. He borrowed $8.75. If the stock price goes up, this goes up and that goes up. The loan doesn't change. Now think about that the opposite way. In this case, the price went up. If the price went down, those two would go down. That doesn't change. Okay, number 18. Alan Dagley bought 300 shares of stock at 95 per share using an initial margin of 60%. Given a maintenance margin of 35%, how far does the stock have to drop before Alan faces a margin call? Okay, now I can blow this up a little bit so you can see the formula better. I'm using that formula right here. The margin is 35. I'm filling in and solving for V, and then dividing that by the number of shares. That's how I'm getting it. Price per share is 95. It can drop to 58.46 before he gets a margin call. And I'm using that equation, 2.4. It's on page 66 in your book. Margin requirement goes over here, and I'm solving for V. Make sense? Sort of. Okay. Number 19 says, an investor buys 300 shares of stock selling at $65 a share using a margin of 70%. Stock pays an annual dividends of $2 a share. Margin loan can be obtained at an annual interest cost of 4%. Determine what return on invested capital the investor will realize if the price of the stock increases to $84 within 6 months. Okay, this is just like the one we looked at in the thing. Margin dollars, 300 times 65 times 70%. So he's putting that up. The total purchase is that much equity, that much debt. Dividend per share is $2. Margin loan, 4%. It's a half a year. So the interest on the loan is Time per half a year is 117. Price per share that he thinks it's going to go to is 84. The value after 6 months, 25,200. Total dividend is a half of that. You plug all of that in and you get a 6-month return of 43.10. Now in the book, the answer, they called it an EAR, but it's not. It's an APR. They just doubled it. The actual effective return was 47%. So 6-month return, 47% is not too shabby. Okay. Let me get this one. I don't know why I keep getting that, but I want you to see the, if I just go over, there we go. Okay. Number 24. An investor short sells 75 shares of a stock for $69 a share. Initial margin is 60%. Maintenance margin is 40%. Price of the stock falls to $57 a share. What's the margin, and will there be a margin call? Total purchase, 75 times $69. 60% of that. His debt is 3105. His equity is 2070. If the price falls from 69 to 57, the value is going to be 4275. So his account equity is going to fall to 2970. He's not going to get a margin call. He's at 69, maintenance margin is 40. Oh, okay. We get some easy ones here. Calculate the profit or loss per share realized on each of the following short sale transactions. Well, if you shorted it at 93 and you covered at 78, you're going to make a $15 profit. If you shorted at 13 and you had to cover at 27, you lost money. If you shorted at 98 and covered at 75, you made money. You short at 62 and cover at 44, you make money. If you short it, you sell it at 129 and buy it back at 134, you lose money. That was pretty easy, wasn't it? And the last one. Charnel Bitker expected the price of PharmaScript shares to drop in the near future in response to the expected failure of its new drug to pass FDA test. As a result, she sold short 1,000 shares of PharmaScript at $9.75 a share. How much would she earn or lose if she repurchased that 1,000 shares 8 months later at each of the following prices? Well, obviously, if she repurchased them higher, she's going to lose. She can buy them less. So she's going to make money on those two. She's going to lose on the others. Questions on chapter 2? Questions? We okay? Okay, let's take about 5-minute break, and I'm gonna get something to drink. I'm gonna do chapter 3. We'll look at that, and we can talk about the test some, but yeah. Okay, where is getting information? I know where it is. Let's go back. Come on, go down. Close it. There we go. Okay, let's look at chapter 3. Get rid of chapter 2. I want this one. I want to share my screen. Chapter 3. There we go. Okay. Slideshow, come on. From the beginning. Knees, knees, and teeth. Okay. Okay. Look at what I'm doing here. This chapter is on information and securities transactions. So I'm thinking that for your project, this is going to give you some ideas of where to get stuff, where to get information. Okay. As with every chapter, there's our learning objectives. We're going to talk about online investing, sources of information, stock and bond averages, the role of stockbrokers, different types of orders. There is a lot out there in terms of investment information. A lot of, and nowadays with the internet, it's everywhere. Okay. Investment education sites. You probably heard of the Motley Fool, Investopedia. I've never heard of Wise Bread. Khan Academy has stuff on everything. There's tools to help you develop plans, to help you screen stocks, for charting, and of course, stock quotes. Stock quotes are pretty easy. Now, here's some examples. Financial calculators, look at all these. Auto loan calculators, you all want retirement calculators, just everything you want, they're out there. This is one of Zach's stock screeners. You tell it what kind of stock you're after, and it will find some for you. You tell it industry rank, growth strategy, whatever, and it will find stocks that meet that criteria. Now, internet trading. Let's be honest. Trading on the internet, it involves risk. You have to exercise, obviously, the same precautions. There's nobody there like your broker to say, are you sure you want to do this? You should be skeptical of free advice. You should know who you're buying from. You should watch out. And by the way, guys, behavioral finance research has shown men trade much more frequently than women do. So they have higher transaction cost. And you should be aware of the risk of shorting and margin trading. Now, information that you can get, it can be either descriptive or analytical. And for your project, you're going to need both. Descriptive is factual data, performance of the company, the markets, an industry, even that specific investment. And analytical information is the current projections, recommendations from analysts, that sort of thing. And both of those are out there. This is a report containing descriptive information. This is on McDonald's. There's the valuation measures. There's the financial highlights. There's the income statement and balance sheet. There's all the trading information. Now, here's different types of information. Economic and current event, industry and specific company, alternatives, price, and your personal investment strategies. Obviously, the big one, the Wall Street Journal. It's the best known source, reports it's daily. Barron's is another one, and Investors Business Daily. Wall Street Journal is kind of general. They have corporate news, daily, national news, all that kind of thing. There. Economic news. There's monthly economic letters from the Fed, and those are free. Dow Jones, Wire Service, Bloomberg, websites specializing in financial news, CNN, MarketWatch. Business periodicals. Let me move this thing again. I want it out of the way. Here we go. Bloomberg Business Week, Fortune, Forbes, The Economist. Now, all of these are going to cost money. You can get them in the library, but they're going to cost you. Economic and current events. There's an economic report of the president. The Fed, the Federal Reserve, puts out a lot of information. Census Bureau does. Survey of Current Business does. You can subscribe to the Kiplinger letter. And for a specific industry, all industries have periodicals. Chemical Week, Computer World, whatever. You can find something specific to that industry that will talk about it. Again, General Business, Wall Street Journal, Bloomberg Business Week. Company websites. Years ago, if you wanted to do an analysis of a company and you wanted to write about them, you were going to have to call them or write them and get a copy of their annual report. It's all on their website now. Their annual reports are on there, their SEC filings, their press releases, everything's right there. So what used to be an entire semester project can now be done over a weekend, basically. There's a lot of free and subscription resources that are specific to different industries and companies. Hoover's is really good, but it varies. There's a cost for that. CNET is free. My personal favorite right there, Yahoo Finance. It has got everything. I mean, you don't even need to know the symbol for the company. If you want Google, you just type in Google and it'll bring it all up for you. And MarketWatch, those are free. Industry, Reg FD, we talked about this in chapter 2. It requires information to be simultaneously disclosed to investment professionals and the public. because they were having these private phone conversations with analysts and telling them things. There's an annual report. Publicly traded firms are required to publish it. If you own stock, they're required to send it to you. They are required to file a Form 10-K with the SEC, and you can get it right there. Free Edgar. It's their website. You can get all of it. They also file 10-Qs, which are quarterly reports. I think my dogs want dinner. I can hear them. Dun & Bradstreet puts out a lot of data. Risk Management Association, RMA, a lot of data out there. This is from Procter & Gamble's annual report for the years 2014 through 2018. This is just an excerpt. Key information, obviously, in an annual report, they're going to make it look as good as they can. Now, S&P is a subscription service. Mergent is a subscription. Value Line is a subscription. They've got them in the library. And I believe, Value Line. If you need to pick a company and you're going to need Value Line type data, Value Line data on the Dow 30 is free online. Everything else is a subscription, just for your reference. Brokerage reports. If you're a client of a brokerage, they will provide what are called back office research reports. They have people doing analysis and making recommendations all the time. And as a client, they'll provide those to you. And their investment letters. Those are on a subscription basis. They cost money. Now, price information. This is so easy. We can all get it. You could get it. You can get it on your phone right now. You can get it on Yahoo at any time. Current price data, how the price has moved over the year, over the day, whatever. There are a lot of financial portals. There are bond sites. There are specific mutual fund sites. There are international sites, and there are discussion forums out there. So, ton of information. Hard to figure out which is good and which is not. Here's the symbols for some well-known companies. I have it's just picked in there. That would tell you AT&T has been on there for a long time because they've got a one-letter symbol. Google is really alphabet company, Amazon, Microsoft, etc. Okay. Following websites are just a few. CNN Business, The Motley Fool. Yahoo Finance, as I say, is my personal one because it's just so easy. You pick a stock, type in the symbol, pick the stock, you get the quote. You can look at their income statement, their balance sheet, financial analyst recommendations, buy, sell, hold, whatever. It's all there. Bonds. Bonds are not, they're not actively traded at all. They're very illiquid. There are some bond sites. There's Treasury Direct. It's run by the Treasury Department, and it allows you to buy Treasury securities online directly. You buy Treasury bills, Treasury bonds. These are mutual fund sites. Morningstar is the big one. There's an Investor Center and Max Funds I'm not really familiar with. Morningstar is pretty much the gold standard there. All of these cost money. Now, hang on 2 seconds. I'm going to shut the door. I have no idea what their little puppy problem is, but I'll be down there soon. Okay, avoiding scams. I'm sure you've been hearing all this about GameStop and Robinhood. Not so much a scam, but pump and dump. Promoters hype a stock and then sell out. Anything that sounds too good to be true, very likely is. Commodities Futures Trading Commission has CFTC said, don't purchase digital coins on a single tip. Be skeptical of anything, get rich quick, because nothing's guaranteed. Now, let's talk about market averages and market indexes. They're not the same thing. They give you a picture of the overall market conditions, and it lets you compare how your portfolio is doing versus the market. An average reflects the arithmetic average price behavior of a group of stocks. An index measures against a base point in time. It's two different things. I'm sorry, I forgot I had those there. Okay, this is the Dow Jones Industrial Average. It started out a long time ago as 20 stocks. It is now 30. Most of them are large companies. It is a price-weighted index, which means a higher price per share has more influence on the average. And look at the formula. It's just the closing price of all 30 stocks divided by the divisor. Now, way back when it started, the original divisor was 20. You added up 20 stocks and divided by 20. It changes due to mergers, bankruptcy, stock split, anything like that that changes it. The divisor is adjusted, and the divisor now is like 0.87 something. Yeah. The catch is, think about this. And they do make changes. In fact, they just made some. A stock, the Dow committee decides that these 30 stocks do not completely represent the market right now. So they take one out and put something else in. They have to adjust the divisor, because if the Dow closes tonight at 30,000 and we take a stock out and put something else in, it has to open tomorrow morning at 30,000. So the divisor is adjusted. Dow also has transportation average, utility average, they have a composite, and they have a whole bunch of global equity market. Now, S&P, Standard & Poor's. This is more broad-based, the S&P 500. It is the one most widely used for market return in CAPM, the capital asset pricing model. And look at the formula. It's the closing market capitalization of the stocks. So it's, in this case, the company with the most shares times the highest stock price. That's the one who's going to have the most influence on it. They also have an S&P 100, a mid cap, a small cap, a total market. This is kind of interesting. The upper dark blue line is the Dow. The lower lighter blue line is the S&P 500. You got to say, they track pretty well. To think that they are able to pick 30 stocks that can track 500 stocks, the movement of 500 that well, that's really pretty good. The correlation's over 90%. Okay, NYSE, the NYSE market, and NASDAQ, they have all got them. There's a NYSE composite index, everything listed on the New York Stock Exchange. It normally moves pretty much like the Dow. The NYSE market index is on the market exchange, and this is not exactly the same. NASDAQ, the NASDAQ 100 is the big one. They have a composite, it's the most comprehensive. They also have biotech and computer indexes. And these movements are a little bit sharper because they're more focused. Now, Value Line has indexes. They include, 1,700 stocks in the Value Line survey, and they're traded all from all different places. And the Frank Russell. You hear about the Russell 3000? Okay. The 1,000 are large companies. The 2,000 are small to medium. The 3,000 are all of them. And the Wall Street Journal has indexes too, world and European, Australian, Far East. What that tells you is, however your portfolio is aimed, there is an index similar to it that you can use as a benchmark. Bond markets. Our bond markets are not very liquid at all. Treasury bonds, yes. Corporate bonds, no. What they're following here is bond yield, the return if you bought it and held it to maturity. The Dow Jones does have a corporate bond index, equally weighted, 96 U.S. issued corporate bonds. Now, making transactions. Suppose you want to buy stock. How are you going to do it? Is there a role for stockbrokers? Types of orders? Stockbrokers, they can call them all kinds of things. Account executives, investment, whatever. They have to be licensed by the SEC. They have to be members of the exchange where they place orders. You place your order with the stockbroker, He works for a brokerage firm that has a membership on the exchange, and the exchange executes the orders for him. If it's on NASDAQ, then they transmit the order to a market maker and it's executed online. Now, the primary role of a brokerage is to execute purchase and sale orders at the best possible price. It's called best execution. Most clients' certificates are held by the brokerage in what's called a street name. In other words, stock I own is held by my investment advisor in the name of the company in trust for me. Now that does several things. Right off the bat, it means they can loan them out. If somebody wants to borrow them to short sell them, they can loan them. But the advantage is you don't get stock certificates anymore. I mean, I think the one place you can get them is something called One Share, and you can buy like a share of stock and have it framed on the wall. A lot of people do it with things like Disney. Disney's a very popular one because it's got the little characters on it in color. Harley Davidson is very popular. And it is a true share of stock. I mean, you actually own a share of stock. A lot of companies don't issue shares anymore. I mean, why would I want them? If I want to sell, if I own some shares in something and I want to sell them, if they're held in a street name, all I have to do is call my broker and say, sell them, and he does it. I don't have to do anything. Brokerages also provide research information, and of course, they provide me with a monthly statement of exactly what's going on. Full service. They do all of it. Investment advice, they hold securities in street name, they offer margin loans, they offer online brokerage, all of the above. Discount brokers lower commissions, and they may have some research and investment advice available. And your real discount broker, basically all they do is execute trades. They may do it on the phone or over the internet, but that's all they do. And here's some of them. Full service, over here, Morgan Stanley, Merrill Lynch. Charles Schwab, E-Trade, Ameritrade, those are premium. They do offer some research. And here's the one you're seeing in the news right now, Robinhood, basic discount. Okay. Here's the thing, if you want to use a stockbroker, you need to find somebody that understands your investment goals. They need to understand why you're investing. Are you wanting to invest money so you'll have enough money for a house? Do you want to invest money for your child's college? Do you want to invest money for retirement? They need to know what your goal is. They need to understand you need to understand their style and goals because they may not be consistent with yours. If you want advice and help, you're going to pay more. You need to ask around. Who do your friends use, and are they happy with them? And of course, beware of churning. Now, to open an account, single or joint, usually a joint account. Custodial account is for a minor. It can be a cash account or it can be a margin account. Cash account, customer can only make cash transactions. A margin account, you can borrow money. And there's a wrap account. This is account for larger portfolios where you pay an annual fee and a professional money manager handles everything for you. Now, odd lot and round lot. Odd lots are orders consisting of less than 100 shares of stock. Round lots, 100 shares or multiples thereof. Odd lot trading costs more than round lot trading. Okay, types of orders. A market order. A market order demands liquidity. It tells your broker, buy me shares of Amazon, buy me 100 shares of Amazon right now at whatever the best price is, or sell my shares of ABC right now at whatever the price is. No delay, no nothing, he does it. A limit order is a priced order. It supplies liquidity. You say, I will buy 100 shares of Amazon if the price is $300 a share or better. Or I will sell if the price is $250 or better. It doesn't execute if they can't meet that criteria. And there's the three kinds down there. Fill or kill. If you can't do it immediately, the order's canceled. A day order, it expires at the end of the day. Most would be good till canceled. It remains in effect for 6 months unless it's executed or renewed. Stop loss. You heard a lot about these with Martha Stewart. This is kind of an odd order. It's a suspended order. And back up here. Limit order, if it says, I want to buy at $300 or better, or I want to sell at $300 or better. If the price goes to 301, and while they're trying to sell it, it drops back to 298, it doesn't execute because they cannot execute at 300 or better. A stop loss order, if it says, well, this is to play, this is to sell. If it said to sell at 300 or better, if the price is at 300 and it drop and it hits that, then this turns it into a market order. Once it's activated, it becomes a market order, and the pricing part of it doesn't matter anymore. It's used to prevent, as you can read it, adverse effects of a rapid decline. You can use them to stop orders to buy stock too, to limit the risk. Stop limit. It converts it to a limit order. Now, day trading. We used to have a lot more of this going on. I don't think so much anymore. This is the guy who buys and sells quickly throughout the day. He's trying to make quick profit on just a very small change in price. It's really risky and it's expensive because there's a lot of trading and a lot of commissions in there. You're doing it online because you've got service outages. If you're trying to do it on the phone, you've really got a problem. Day traders try to go home what are called flat at night. I don't want to own anything overnight. I want to get in and out during the day. Now, if you're going to trade on one, and I know people who do, you need to know how to place and confirm your order before you start. Verify the stock symbol. Use limit orders. They protect you. The worst thing that can happen with a limit order is it doesn't execute. It's not going to execute at a bad price. It just may not execute. Do not ignore it when they remind you to check and recheck. Have a strategy. Don't get carried away. It says open an account with 2 brokers and double check. This is, I know we all shop online now. It's really easier on Amazon. Just click buy. But in this case, you're talking about some big money. Transaction cost. Fixed commissions, small transactions, that's mostly us. Negotiated commissions are for big institutional traders. There is some protection. SIPC, Securities Investor Protection, you can read right there. It insures each customer's account up to $500,000 for securities, $250,000 for cash. It doesn't mean you're going to get the dollar value of your securities back. It only the securities will be returned. It's protecting against the financial failure of the brokerage, not against bad advice. Now, SIPC requires mediation and arbitration. Mediation is informal and non-binding. Arbitration is binding. An investment advisor. It could be an individual or firm. They provide advice for a fee. There are investment clubs, and I actually spoke at one several years ago. It was a group of people who got together and put in money every month, and they made decisions about investing for the group. We'll talk about it. This Investment Advisors Act of 1940, this requires investment advisors to make full disclosure about their background, any conflicts of interest. You want to look for somebody who's got one of these professional designations. For personal investing, CFP would be the one right there. CPA, we know what that is, accounting. CFA, Chartered Financial Analyst. CFP, all of these have taken extra schooling, have had extra class academic work specifically aimed at what they are advising on. They have to do, they have to keep up each year, do extra work. They have a code of ethics. So you want to be sure you're dealing with someone. I had never heard of a robo-advisor, but apparently there are some. They are generated by computer algorithms. Apparently, I got to go try one. Apparently, you put in information about yourself and your investment and what you're trying to do, and the algorithm generates advice. That would make me a little nervous, but apparently it is. Okay, the cost of investment advice. Small portfolio, it's going to be 2 to 3% of the funds under management. Larger portfolio is going to cost a little less, of course. And online, a lot of that's even free. Wait, what have I done? Okay. You want to look for advisors with good performance. You should expect a lot of questions from your advisor. They need to ask you, as I said, about your goals, your investment horizons. They need to have a clear understanding of your risk tolerance. There we go. Here we go, the investment clubs. It's a legal partnership. They get together. There's a whole bunch of them here. They pool their knowledge. The members make stock recommendations and they decide what to buy. There's a whole community of them. There's a whole bunch of them around the country. I haven't heard of any in recent years, but there are some. That was chapter 3. Hopefully, those of you who are doing your investment project, that gave you some ideas and some places to look for some information. Okay, let me get the thing I want. I can close that one. Bring this one up. And I want to share my screen. Share my screen. Where is it? There it is. Let's look at the problems. You get the book. Okay, number 2. Imagine that the mini Dow average, MDA, is calculated by adding up the closing prices of 5 stocks and dividing that sum by divisor. The divisor used in the calculation is currently 0.775. The closing prices for each of the 5 stocks in the MDA today and exactly 1 year ago, when the divisor was 815, are given in the table. There's the table. In fact, maybe I can make the table a little bigger. Get on the thing. There we go. Okay. Calculate the percentage change in each stock. Okay. Percentage change is always new minus old divided by old. So Ace went down, Coburn went up, National Soap went down, Ronto Foods went down, Wings went down. Overall, the whole thing went down. Calculate the MDA today and that of a year ago and the percentage change. Okay, there's the sum. There's the MDA today and a year ago. So a year ago, it's gone up. Okay. Number 3 says, imagine that you want to create, let me get this a minute. Yeah. Imagine that you want to create your own stock index to measure the performance of the stock market over time. You decide to use a methodology similar to that used to calculate the Dow. Your index will contain 10 stocks carefully selected from different industries. The price of each stock is given on June the 1st, 2017, June the 1st, 2018. For simplicity, assume that during the year, no stock splits, nothing happened. And that would require an adjustment of the advisor, which is 13.5. So the divisor is going to stay the same. Okay, same question, percentage change. 2018 minus 17 divided by 17. There they are.
Okay, I got a question, Dr. Kugerly. What does the percent change tell us based on the particular stock?
The price went down. I mean, it's just telling you those went down. That one, the overall, it went down. It's just Okay. Part B says, now use equation 3.1 to calculate the value of your stock index on each date and the percentage change on the index over the period. Okay. There's the sum. We're just adding them up. We divide by the index. Here's the average a year ago. Here's the average today. Because the divisor didn't change, the percent change is exactly the same. Change in the average and change in the index were exactly the same. Okay, number 6. These get a little smaller now. Imagine you placed a limit order to buy 100 shares of Hare Mining Company at a price of $68, although the stock is currently selling at $71. If the price drops to $69 before the cancellation, it won't execute. If it drops to 65, it will. If it drops to 68.50, it will not. It's got to drop to 68 or below to execute. Let me put this down just a tad. Why am I not getting? I've got this. That's awfully small, but I want you to be able to see. Well, let me look. I'm trying to get it on the screen so you can see it a little bit better. Okay, that may be as good as I can get. You've been researching a stock that you like, which is currently trading at $39 a share. You'd like to buy the stock if it were a little less expensive, say 36 a share. You believe that the stock will go to 59 by year end and then level off or decline. So you decide to place a limit order to buy 100 shares at 36 and a limit order to sell at 59. Turns out you were right about the direction of the stock and it goes straight to 64. What's your current position? Since the stock never fell to the limit order buy, you've never bought them, but you sold them at 59. So you're now short 100 shares and it's currently selling for $64. So you're going to have to buy it at 64 in order to cover your limit sell at 59. And the last one, you have $5,000 in a margin account, in a 50% margin account. You have been following a stock that you think you want to buy. Stock's priced at $52. You decide that if the stock falls to 50, you'd like to buy it. So you place a limit order to buy 300 shares at $50. The stock falls to 50. What's going to happen? Nothing. Because you don't have enough money in your margin account. You've got 5,000 in the margin account. You need 7,500 to buy it. So nothing's going to happen. Those weren't bad, were they? Stop the share. Those weren't bad. Questions? Okay, test is next Monday night. I've canceled the Zoom meeting, obviously. Proctorio, print the formula sheet. You can use scratch paper. You can use your calculator, whatever. It's test is open from 6 to 9. And this one, like I say, I'm not overwhelmed with it myself, but because there was quite a few calculations in these problems, but they weren't suitable for Blackboard. They weren't suitable for a Blackboard test. So you're getting out, I don't know. Most people don't like the conceptual questions very much. 25 conceptual at 3 points each, that's 75 points. 5 problems at 5 points each, that's 25. Okay. Questions about anything, about the test, about anything we're doing?
I have a question about the project.
Okay.
What do you want us to email? Just what like a stock or whatever we're doing?
Yeah, just a name. Like
okay.
Somebody's doing FedEx, somebody's doing Tesla. I don't care if 2 people do the same thing. It doesn't matter. I just want you to get the experience of following a stock and looking at looking at some of these sites that we just looked at.
Yes, ma'am.
So you kind of see what's available.
Yes, ma'am.
When we're live, I tell you exactly, I've used it when we're live. It takes up that last class before final exams when you can't really do anything. But it is a good little project to do. It introduces you to what all is available out there in terms of information. So a lot of people pick a company they work for. They just pick something they're interested in, whatever. It can be a stock, a bond, a futures contract. You can follow soybeans. You can follow, what's the one I followed? I followed cocoa in college. Yeah.
Okay, thank you.
That answer it? Okay, anything else?
Can you give an example of what you mean by like a conceptual question? Like, is not really based on just the terminology?
Hey, it could be definitions too.
Okay.
Definitions type thing. I tell you what, after we sign off, I will go actually look at the test and give you a freebie. How about that? I'll give you one so you can kind of see I'll give you one that's a good example of what they look like. Okay. because I made the test out quite a while ago.
All right, thank you.
Okie doke. Anything else, guys? We're good. Except for the dogs wanting dinner. This was pretty good. And my signal is awesome. I mean, look at this. What happened there? My signal is fantastic. I mean, I haven't had any of that unstable internet coming across the screen. I don't know what we did, and it cost me some money, but it's okay. This is all working. I'm happy. I'm happy.
Thank
Okay,
you.
any questions you come up with, email me. I do not mind at all. Email me about the problem with my finance lab, and I will go pick a question out of the conceptual ones and email it out or email it out to everybody so you can see it. I'll kind of give you a thing. Like, I know I'm a numbers person, so I prefer the quantitative problems myself. This just didn't have that many to pick from. It wasn't, there weren't that many good choices. So it'll get better. Okay, doke. Y'all have a good one. See ya.